I will be talking about benchmarking and comparative analysis of stocks. But before I dive into the content, this is just a disclaimer. So I'm not a professional advisor nor accredited investor, and the following information is based on my experience and from what I know. But all of y'all must know that investing is risky and due diligence is required. And please treat this sharing as a form of education or entertainment. And this presentation is never professional financial advice. Okay, I will start the presentation proper. So first and foremost, I want to introduce to all of you all with this concept known as the market sectors. Okay, so for market sectors, there are 11 of them. Okay, so firstly, what you can see on this diagram is the energy sector, followed by materials, industrials, utilities, healthcare, financials, consumer discretionary, consumer staples, information technology, communication services, and lastly, real estate. Okay, so I will provide you some examples of these sectors. So for energy, basically is referring to the businesses which are involved in the exploration, production, refining, and sale of energy resources, including oil and natural gas. And some of the companies in this energy sector will be like ExxonMobil or Chevron. Okay, so for the next sector will be materials. And material sector would include businesses involving in the manufacturing of construction materials, chemicals, papers, and glass. Okay, that would also include the mining companies, right? Okay, so the next sector I will talk about would be the industrial sector. And for the industrial sector, it will include businesses involving industrial machinery construction and engineering like Caterpillar, aerospace and defense, okay, and electrical equipment. So these sector would include businesses such as Boeing, Honeywell, this kind of aviation or production or manufacturing or engineering company, right? And for the utilities sector, this is quite straightforward. So these are the companies dealing with utility services such as water, electric, and gas, right? And for healthcare, which is also our sector, would be inclusive of pharmaceutical producers or companies, medical devices companies, healthcare service providers, biotechnology, and also insurance companies. So why insurance companies is because in the US, they are having private insurance. So these insurance companies are embedded within their healthcare group as part of a healthcare administration. Okay, so some healthcare companies would include the United Health Group and also pharmaceutical companies like Pfizer, right? So the next sector would be financials, and financials, of course, would include the banks, right? So apart from banks, it would also include financial service providers, asset management companies, and also financial brokers. So some examples of financial companies would include Visa, JP Morgan, and also banks like Bank of America. Okay, so for consumer discretionary, this is something that like what is mentioned over here is discretionary. That means you can choose or you decide to buy, right? So this is also known as the consumer cyclicals company, and these companies will be involved in retail, e-commerce, hotel, luxury goods, and also leisure and travel industries, right? And in contrast to consumer staples, which I will talk about later, these are the various goods and services which are generally those that consumers don't necessarily need to have. Okay, so some of these examples would include Amazon, Tesla, and Home Depot. Okay, so I'll move on to the consumer staples sector. So these companies would include businesses involving food, beverage, and also household goods. Okay, so this is a defensive sector because these are the types of goods and services that consumers need regardless of their financial conditions. Okay, so just remember these are defensive sector, or we can call it also the recession-proof industries. So in the Singapore context, one thing I can think of is really like Sheng Siong, right? The supermarket company. Okay. So in the context of US, such companies will include Walmart, P&G or Procter and Gamble, and also the Coca-Cola company. Okay, so then I'll move on to the next sector, which is the technology or IT sector. So this includes multiple subsectors and industries from a semiconductor producers, like TSMC, Taiwan Semiconductor Company, and then NVIDIA, right? Also Tesla comes under this. So software and hardware providers, and also internet stocks, inclusive of cloud computing. Okay, so this sector includes companies with some of the largest market capitalizations in the world, such as Apple, which is the most valuable company, right? Microsoft, and also Amazon, right? And for communication services, this is really the telco sectors. And these would include the wireless telecom networks, media and entertainment companies like Netflix, right? And then newer interactive media and internet companies. Okay, like AT&T, or in the Singapore context would be StarHub, M1, Singtel. Okay, and last but not least will be the real estate. I think this is quite easy to understand. So for real estate is really the buildings or the developers or even the commercial and offices. So for real estate sector, this would include developers like CapitaLand, okay, in Singapore, and also the various REITs, the real estate investment trust. Okay, so this would summarize the various market sectors, and also what are the various characteristics, and also the businesses or companies involved. Okay, if you have heard me mentioning just now about the word cyclical versus non-cyclical, the difference between cyclical and non-cyclical will typically be whether is it defensive or not, right? So anyone can hazard a guess which one is referring to defensive, cyclical or non-cyclical?
Non-cyclical.
Yeah, non-cyclical, because they don't follow the cycle, right? So that would mean that the non-cyclical is having a inelastic demand, right? And these are the companies or the goods and services that are provided by the non-cyclical companies would be a defensive one, which means that people like us, we must buy or we usually will need to buy their goods and services. Okay, so like for example, Sheng Siong did very well during the COVID period because of course NTUC is not listed, right? So Sheng Siong is the probably one of the two. The other one should be the dairy farm industries, DFI, right? So they are defensive, and Sheng Siong did very well, and they are growing dividends very well, dividends year on year. So that is a typical non-cyclical or defensive stock. But in terms of cyclical, can anyone provide an example for cyclical companies in Singapore? Hotels, right? So during recession, or global recession, what happens, or even the COVID pandemic, what happens to the hotel? The hotel industry or hospitality industry totally wiped out, right? Annihilated in a sense. So those are cyclical, right? So there are also differences between the cyclical and non-cyclical stocks, as you can see on this comparison chart, right? So what are the advantages? So for cyclical stocks, they have bigger exposure to the movements in the wider market, which means the swing or the price, they can go up and down, can be very huge. But that would mean that there's also benefits that we can reap lah, as compared to non-cyclical stocks, because non-cyclical stocks are usually quite boring in a sense, right? And then they are within a certain range in terms of the price. But for cyclical stocks, when there is some trend or fad, suddenly the cyclical stocks will just boom. Okay, so that would also include having more profits during a rising economy. So it's important for us to understand at which point of the economic cycle would be relevant for us to go in and buy the cyclical stocks versus the non-cyclical stocks. Okay, so as compared to the non-cyclical stocks, of course, cyclical stocks would be having high volatility, but high volatility doesn't mean it's bad. High volatility, in fact, can also be advantageous to us. But what sets apart is really the entry price. Okay. Right. So I spoke about cyclical stocks and non-cyclical stocks just now. So economic cycles and also stock market cycles, they are what is presented on this particular slide. So you can see the various market sectors, right? And at different points, what is the best entry point for each of these economic and also the stock market cycle. Okay, so on this chart, there are two cycles over here lah, economic and also stock market. And can you all hazard a guess again, which is more leading? That means which one is ahead of the other? Is it the economic cycle or stock market cycle? Just to test you how to read the chart, which one is leading, or which one actually can predict better or more forward looking? Economic or stock market cycle? Anyone? Okay. The answer is the stock market cycle, because this is the cycle or the chart that starts first lah, followed by the economic cycle. That's why at during market talk, or the chat amongst the market players, right? They always say that the stock market cycle is actually predicting 6 months ahead of the economic cycle. Right, so when there is a bearish trend in the stock market, that is probably one of the signals that we are entering a bad economic environment, or possibly recession. Okay, so because when the earnings are bad, okay, or the performance or the news on the street, they are bad. So what happens is that the traders, or even the big banks, will then sell off their stocks, right? So that is predictive as compared to economic cycles. So just remember, stock market cycle is leading, is a leading indicator. An economic cycle is a lagging indicator. Okay. Okay, so for today, I just want to share two examples from two different sectors. And for today, I will talk about the financials and also the real estate. Okay, I think this is a very favorite topic among Singaporeans, and I'm quite sure all of us, or some of us, might have already gone in to buy some of our Singapore bank stocks. Okay, so maybe before I dive into this slide, right, can anyone tell me if the three Singapore banks are part of the STI, the Straits Times Index? Are they in the Straits Times Index?
Yes.
Yes. Okay. Thanks. Anyone can share with me what are the three banks? The three Singapore banks on the
DBS,
STI? Yes, DBS.
OCBC,
And
UOB.
one, yep, UOB. Okay, these three banks have been like on a bull charge. Okay, not even run it's a bull charge since COVID times, right? Because when interest rates are high, they earn money. Okay, when interest rates are being cut, they are still maintaining a strong momentum, right? Because when there is easy money, there are increased borrowings, right? So in Singapore, the banks are highly capitalized, means that they have a lot of money in their reserves, right? That's why they are able to guarantee the SDIC deposits, right? Mm. So the three Singapore banks are part of the STI index, and that is one of the reasons why STI has been performing quite good or relatively well in the past 1 to 2 years. I think especially for this year, if I'm not wrong, they also went up by quite a bit. If I'm not wrong, it's about 200 points. Okay, so I think in the recent run, the Singapore Straits Times index is something that have performed quite well, right, as compared to the S&P 500 or even the DJI, right? And what I can say is for STI, it is usually a bit boring as compared to S&P or even the Nasdaq, is because the truth is the bulk of our STI components, and also at the same time for the Singapore stock market, they are very dividend driven. Okay, so why do I say that is because I think for a lot of Singaporeans, they are very dividend seeking. Okay, and therefore what is the disadvantage of dividend payouts or dividend paying companies is that where do the dividend come where do the dividends come from? It's actually from their profits, right? So if they give out dividends through their profits, do you think that they have enough cash to invest in their business to expand and scale up their businesses? So that is a no, right? Yeah. So why Singapore market is a bit boring is because mostly the Singapore companies are dividend paying companies, and therefore in terms of the cash being put into their businesses would be much lesser, and therefore the scale and also the amount of cash or profit being generated from scaling up their business would be much muted as compared to the companies in the US, where especially like the Nasdaq, the companies are largely or almost all are not dividend paying companies, and therefore they reinvest their profits into the business in order to scale up the business. So in terms of the stock prices move by their earnings per share. So whenever there's a positive news for their EPS, yeah, basically the stocks will just boom. Okay. All right. So going back to banks, I will talk about the Singapore banks over here. So on the right side, what you can see, there is a typical brokerage report. So this brokerage report is issued by UOB Kay Hian. Okay, they don't do this on a daily basis. Usually the sector update is as and when, or it's probably on a quarterly or even a 6 monthly basis. Okay, so what do the brokerage firm do is that they will look at the various sector. So in this case is banking, and banking within Singapore is a small sector because there are only three main banks. We don't cover the external or foreign banks, right? So what they do is they have a deep dive analysis of the three Singapore banks over here. Okay, they will talk about the macroeconomic trends. Okay, especially like for example the appreciation of a certain currency, how is it impacting the various banks in Singapore. Okay, and then what are the non-performing loans across the three banks, exposure across different regions, etc. Like for example, OCBC is quite highly exposed in the China market. So how does the People's Bank in China, the monetary policy or the fiscal policy can affect the borrowings or the performance of OCBC, right? So this would all be covered more or less inside this sector update. Okay, so that is a typical brokerage report. Okay, so today the topic is about benchmarking and comparative analysis, right? So on the left side of this slide, you can see the three charts over here. Okay, can anyone tell me what is PB? I covered that in the previous session. Any suggestion? What is PB or P/B? Okay, PB refers to price over book ratio. Okay, price over book ratio. So the lower the value, okay, the lower the value, the better it is for us because it means that it's cheap right? The higher the value, it's not good for us it's because it's expensive. Okay, price to book. Book means that the asset, the amount of asset which a company holds. Okay, book. So on book, how much this company is being valued is the amount of asset that the company has. Okay, so when the price refers to the share price. Okay, so it's fluctuating, right? So price over book. So if the price over book is high, don't buy. Wait until it drops below the median or the average. Okay, so how you read this chart is that what it has drawn over here will be the average line. So for DBS, the average is 1.35x, okay, or times, right? OCBC is 1.49, and UOB is 1.45. Okay, so going by the theory that the higher the PB is bad, the lower the PB is good. So can anyone tell me which of the bank, based on the PB indicator, is the cheapest? DBS is 1.35, OCBC is 1.49, UOB is 1.45.
DBS.
Yeah, DBS is the cheapest, okay, in terms of price to book ratio, okay, because it's 1.35. Okay, so what I can say is that, like you're looking at these three charts, basically, when is the best time for us to buy? It's quite clear cut. Anyone can tell me which year? From 1991 to 2024.
99.
Correct. Very good. 99. What happened 99? Anyone can tell me what happened during the year 1999?
Crisis.
Yeah. I 99. if I'm not wrong, it's the dot-com bubble crash, which is
Oh, okay.
2000. Yeah, because 97 is the Asian financial crisis. The currency I mean I'm not sure if you all remember, it's the Thai baht that was having the bank run and stuff. That was 1997. Then nearing 2000 there was the dot-com crash. So everyone ran down. So why did it affect the banks? The dot-com crash. Anyone? Companies survive based on what?
Cash.
Cash, yes. But cash, are they having 100% cash from their goods and services? No, right? What do?
Mm.
They borrow.
Invest. Mm.
They borrow from the banks. And especially tech companies, right? They borrow a lot. Okay, they borrow a lot. So that would also mean that during the high inflation rate, it actually impacted on the tech companies because the interest is too high for them to get money to fund for their operations. Right? And at that point in time, the dot-com bubble, so you can see that, at the start, 93, 95, this is probably the peak that they have. And then suddenly when the dot-com crash, right, all the companies, close down, shut their operations, and therefore that probably explains why they reach at the very, very low PB ratio over here. Okay, so the COVID period, right, as you can see, is over here, right? That's why you can see there's a dip nearly to the -2 standard deviation. So the lower the standard deviation, okay, the better price that you can look for for you to enter, right? For me, if you are a contrarian like myself, I would definitely buy at all these troughs, right? This is the best time to double down, right? 2016, right? And then COVID crash 2020 over here, or 2021. So these are the periods where it's -2 SD, and then it's the best entry price for you to go in. Okay, anything in the -1 or -2 SD would be the best to go in. Okay, but for today, I will talk about what is comparative analysis. So for PB, DBS is cheap, right? Okay, so going down to the middle part, which is the peer comparison. Okay, so these are the three Singapore banks, and REC refers to recommendation by analysts. Okay, so DBS is a buy under UOB Kay Hian. Okay, OCBC is a buy. UOB NR means not rated. There's no coverage report or no brokerage report for UOB. Okay, so this is the recommendation. This is the price as of 16 October. Target price is based on their valuation methods. Okay, in order for them to derive the target price of the particular share. Okay, so for example, if DBS is now $39, the target price is 42.70. So there's still upward room movement of $3.70. Okay, but this is not something that is just a calculation or indicative, right? It doesn't mean that the stock will eventually reach 42.7. It might be lesser than 42.7 or even exceed beyond 42.7. But based on the valuation method used by UOB Kay Hian, they are looking at a price target for DBS as $42.7. Okay, so now I'll move on to the various financial ratios over here. So we talk about PB lah, right? What is PE? Is it physical education? No, right? P is what? What is P?
Earnings.
Earnings, okay, E. Yes, very good, correct. So price to earning ratio, right? So I mentioned just now, PB, the higher, the better or worse? PB, the higher,
Lower. The
lower
lower the
is
better.
better. Lower is better. Then PE leh? What about PE?
The higher the better.
Higher the better? Okay, anyone else? Anyone has a different answer? PE higher the better.
I don't know, I think should be the other way. Should be lower the better, is it?
Yes, correct. So PE, right? PE ratio, the lower the better, the higher the worse. Why? Always remember, if the price is in front, or is the numerator, right? The value or the X, if it's the higher is worse, because that means you're paying a higher price, right? So for this kind of price related ratios, usually or always it would be the lesser the better. Okay, so PE ratio is a form of a way to calculate whether is it expensive or not. Okay, whether is it expensive or not. So our usual rule of thumb is that if a PE ratio of 15, okay, it is at the border to say that it's neither cheap, but it's also neither expensive, right? But if it goes beyond that, then it's a bit more expensive. But this is just a rule of thumb. It may vary across industry, and therefore we need to do comparative analysis or benchmarking. Okay, so now I want to ask all of your PE, right? So DBS 2024 forward PE is 10.2. 2025 is 11.1. Okay. OCBC is 9.1, 9.4. UOB is 9.1, and then 8.9. So which bank is the cheapest based on the price to earnings ratio? Which one would you buy? Based on the 2024 forward and 2025 forward. Which one would you buy? Anyone? Based on the PE. Remember what I said? What
UOB.
PE? Okay, UOB. Why?
The lower the PE, the better it is.
Yes, correct.
Gary, you're muted.
Oh, sorry. So I will repeat. So basically under PE, okay, looking at their PE ratio at 9.1 and 8.9, this is the cheapest. Okay, so I will buy UOB. Okay, so that's a star. Right. Okay, so PB, we spoke about it just now. So okay, why I am showing this star, right, when we talk about DBS being the cheapest? We are talking about now, okay, rather than average. Okay, so if I talk about now, UOB is in fact the cheapest. Okay, and it's comparable to OCBC, because it's just a 0.04 difference, right? Okay, so that's for the price to book ratio. Okay, and for this is the amount of cash it holds. Okay, so if the price is low, then it's good. Yield is referring to dividend yield. Okay, which I spoke about. So this is the distribution yield also lah, dividend or distribution yield. So which is good this time round? Higher the better or lower the better? Dividend yield. Anyone?
Higher better. Dividend.
Yes. Yes, correct.
Definitely, yeah.
Higher the better, right? So who's the winner here?
Seems like DBS.
Yes, correct. It's DBS, right? On average, okay. So DBS. So you imagine the dividend yield is high for DBS when DBS in terms of the price is the most expensive. So in fact, the distribution per unit is really, really very high. Okay. So I will move on to the next indicator, which is ROE. Okay, our ROE refers to the return on equity. Okay, so that means every dollar I invest, how much return do I get back? So this one higher the better or lower the better?
Higher.
Higher.
Higher, right? Because for every dollar that I invest, I want the returns to be higher lah. Okay, so in this case, which bank is the winner?
DBS.
DBS, yeah.
Yeah, DBS. So for every dollar being invested, DBS returns 14 or 16.9 cents or 14.6 cents. Okay, correct. So ROE, the higher the better. Okay, going back to the yield or dividend yield, can anyone tell me what is the formula? Because just now I spoke about, wow, DBS, even though the share price is so high as compared to the other two banks, it has the highest dividend yield. Can you tell me why did I make that statement? Referencing to the formula for dividend yield. Anyone? So the formula for dividend yield is the annual dividends or distribution per share. That means for $1 or for every unit, for every one share, they give out X number of cents or dollars. Right? So annual distribution per share divided by the current share price. Okay. So the formula for dividend yield is the distribution per unit over the current share price. Okay. So what? So when the current share price is high and is the denominator, right? In order for you to get a high dividend, your distribution per share must be high also. Right? Yeah. So that is why I'm quite surprised that DBS, even though it's the higher the most so-called the most expensive stock, but the yield is still it trumps the other two. Right? So it means that the distribution per unit is also very high. Okay. Okay. So okay. So I'll
Gary,
move
these
on
are
to
but these are just forecasts only, right, for the next year.
forward. Yes.
And then of course when these figures come out, right, is it going to be also like sort of based on next year's macroeconomy? Because dividend they can just announce they cut by
Of
how
course.
much. Yeah. So actually,
Yeah, so Dennis, so just to address your question, right? In fact, every day, this dividend yield percentage can fluctuate. Why?
Because the price of the stock go up, go down every day.
Exactly.
So
Yes, correct. So so that is the reality lah. So for macroeconomic indicators, of course, why every bank will have their chief economists, and their economist team. Yeah, that is where they also need to look around at the macro point of view to see what's exactly upcoming or forward. That's why 2024 F means forward lah. So what is predicted lah? It's not the actual yield that we are looking for that particular year. So it's definitely estimated or forecasted. Okay. So yeah, and like what I mentioned previously, in terms of their price target, all those things, they definitely look at the a certain valuation methodology in order for them to derive the final price target. Okay.
Since there are so many indicators, but which one should we be looking at? Like if
okay.
some indicators is very high, then some is low, then how do we decide?
Yeah. So
buy all three.
Isin, so well, okay. Anyway, I don't think we have a lot of money to buy all three. Later, there's a purpose for this star. So that is my method lah. You all can reference. So there's a purpose behind having these stars. So later I'll explain. Okay. So for the last table at the bottom, projected DPS. DPS refers to distribution per share or dividend per share lah, right? And the dividend payout ratio. Okay, I want to talk about this payout ratio because that's what I mentioned at the start, why Singapore or STI index is not as exciting as Nasdaq or S&P 500. Okay, so for EPS, EPS refers to earnings per share. So earnings per share, the higher the better or the lower the better? Earnings per share.
Higher the better.
Yes. Okay, so who is the highest? Who is the highest?
DBS.
On
UOB.
average, UOB lah. On average lah. I'm looking at forward also, right? So
UOB,
UOB, right? Okay. How about DPS? DPS refers to distribution per share.
distribution.
Which one is higher? Or highest? Sorry.
DBS.
Highest.
DBS.
DBS. Yes, DBS. Okay. Okay, I want to talk about payout ratio. Anyone heard of payout ratio?
Yeah, it's like the amount of percentage they need to pay out for their earnings, right?
Earnings, profit.
Profit. Yeah.
Correct. Yes, correct. So at the start of this session, I talked about this also, right? So because why our Singapore companies, when they are dividend paying companies, they actually dip into their profits to pay out as dividends, right? So payout ratio in terms of the formula, it is the dividend per share divided by the earnings per share. Okay, I repeat. For payout ratio, it is the dividend per share divided by the earnings per share because it dips into the profits. Profits means earnings. Okay, so for a healthy payout ratio, it's usually 60 to 70%. Okay, if the company is dividend paying. Okay, so a healthy payout ratio is 60 to 70%. Okay, then now I want to ask you, of these three banks, which are the banks have good room to provide more dividends?
OCBC and UOB, because they only give 50%, so I think it looks like there's more room for more.
For more dividends, right? Okay. Anyone? Yeah. Any others? Any suggestions? Other suggestion? Okay. So yes. For OCBC and UB, they definitely have more room for dividend payout because DBS probably already reached the ceiling of the healthy range for the payout ratio, right? So it's more or less there already. But for OCBC, they have and UOB, they definitely have room, and UOB has the most room for more dividend payout lah, right? So that is why I listed UOB as the best bank under the payout ratio. Okay, so dividend yield, just now we mentioned, right, the higher the better, right? So DBS is the winner for this. Okay, so just to address Isin's inquiry, right? So how do I choose? Right? So now with all these stars, you all are seeing stars also, right? So how do you conclude or deduce which is the best bank that you want to go in? So what I will do, very simple, is to compute all these stars, right? Right, this is the most straightforward kind of rating mechanism for you to decide which bank to buy. So okay, I don't need you all to count. I counted for you all. So which bank you should buy?
UBS.
UOB.
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 UOB, correct, UOB, because through our analysis over here, right, UOB has 6 stars. Okay, but this is not an advice for you to go and buy UOB now. This is just to teach you all the methodology of how to look at all these financial ratios to make sense out of things, and then you develop your own approach to buy whatever banks that will suit to your style and preferences. Okay, so this is my way, right? I will look at the the charts, look at the numbers, financial ratios, and then also look at the distribution and the dividend payout ratio. I want to ask you all, what is lacking in this comparison? Or is already comprehensive already? What do you think? There's something lacking, We talk about price to book, we talk about price to earnings, we talk about yield, we talk about equity, right? Return on equity. What is missing?
The risk.
Good point. What is the risk? What risk are you referring? Debts, correct.
Actually,
okay. So for banks, the thing that we should really look at, I mean, apart from the operating expenses, all these things, right? What is the one thing we should look?
but those debts are quite stable, quite low for the 3 banks after post
Yes, I know.
2008.
But yes. So Dennis, what is that indicator that we should look at for banks? When it's high, we better put some attention to it. What is that indicator called?
Forgot already, but I think
yeah, correct. You got the first word. Non-performing loans.
non-performing loans. Yeah.
NPL. That is the indicator that when it is on the uptrend, you better open your eyes wide and dive into what exactly is happening for the
But
particular
the
bank
3 banks very
when the
kiasu one.
NPL.
I think only 1 point something.
Yeah.
I remember very low. All very low one.
Yeah. But that would matter whenever there's a crisis that happens.
That's true.
Right. Yeah. So non-performing loans. That is not here. Okay. This is all the very nice things, how much you earn, what's the dividend yield, but one thing is missing, which is the debt. Okay, just to take note. Okay, so we've gone through the banks. I want to
I
talk
ask you
about
one quick question. So like
yes.
for banks, right, usually every time they forecast their earnings every quarter, right, then do
Mm.
you actually look at whether in the past 3 to 4 quarters, whether do they meet the estimates?
Of course.
So
Because
it's hard to predict, right? Like if you want to buy
it's
before they
definitely hard to
announce.
yes,
So
it's definitely because
don't
you can't time the market for sure. You will never able to time the market. Economies can only project whatever they have, right? At that point in time, right? Things are still really in very it's very fluid still lah. It's still very dynamic one. they can only plan based on what parameters they have at that point in time. So yeah, it's hard to time the market lah, for sure. But it's good to look at their track records also.
Okay.
Okay?
Yep.
Okay. Any other questions for banks? If not, I'll move on to REITs. I think we are running a bit short of time. Okay. Okay, so for REITs, I will just go through this very quickly because I would recommend you all to visit this website called REITsweek.com. Okay, so basically what this is like a stock screener. Have you all used stock screener before? Okay, stock screener means for example, right? Like the example I shown to you all earlier. I want to look at PE ratio. I want to look at PB ratio. I want to look at dividend yield. I want to look at ROE. Okay, let's say these four, right? So for PB ratio, like what we talked about just now, the lower the better, right? So I will say that, okay, I want to look at all stocks that are below 0.8 for PB ratio. Okay, then for dividend yield, I want it to be at least 5%. Okay, So this is a stock screener. So the stock screener based on all your filters, okay, or the parameters that you have set, then they will screen and filter out those that did not meet your criteria. Okay, so that is called a stock screener, right? So for this website, they are focusing specifically on REITs. Okay, so what are the important things for you to note about REITs? Will be NAV, net asset value. You just remember asset, there are two parts. Okay, there's long term, there's short term. Short term is highly liquid, long term is illiquid. Long term refers to equipment, plant, or buildings, right? For the short term assets would be your account receivables. That means your cash, right? Things that you can liquidate within 3 to 6 months. Okay, so NAV means your net asset value. How much assets are worth? You are worth that per share or per unit. Okay, so that's NAV per unit. PB, I already shared with you all before. Book value and asset value, they are similar. Okay, so price to book ratio will be the price to your asset. Okay, so higher the worse, lower the better. Dividend, higher the better. But you need to look at whether is it sustainable or not. So the structure for REITs is that out of the 100% of the profits, yeah, 10% is used to pay out for sure. Okay, 90 is retained for their operating expenses. Okay, so they must pay out. They must pay out to all the shareholders or the unit holders because that is the structure of REITs. Okay, so later I'll show you some examples where the highest dividends might not bring you the best company. Okay, the next one is called gearing ratio or the debt ratio. Gearing ratio or the debt ratio, they are synonymous. Okay, so for gearing ratio, if I'm not wrong now, it's up to 40 or 45%. Okay, so once you hit that one, it's a total rate already. That means you cannot borrow money from banks to acquire new assets. Okay, because the assets which you think it is distribution accretive, that means it adds on to the distribution per unit, but you're unable to do so because you have a high net gearing ratio. Okay, so the healthy ratio is between 20 to 30 or up to 35 lah. Okay, I would say that. So anything beyond that, it's a bit of a red flag. The green region will be 25 to 35%. Okay, So the next, of course, will be looking at the cost and occupancy rate of the particular REIT. Okay, right. So these are the key indicators for you to really help you in your decision making to whether to invest on which REIT. So what I can say is that personally, I look at PB for sure because buildings or real estate, you must look at asset. Okay, dividend, gearing will be my key considerations. Occupancy, I don't really look at it because there's one thing that you must look at it, which is not listed here, and it's called
Rental
the
reversion.
sponsor.
Oh.
No, sponsor. Because with a very strong sponsor, you don't need to even think about rental reversion or anything because they are the price setter. Sponsor. So what is sponsor? For example, right? Plaza Singapura. Anyone knows who's the sponsor?
CapitaLand.
CapitaLand. Okay. VivoCity.
Mapletree.
Mapletree. Okay. So these are our local companies, right? Do you think they are strong?
Yep. Yes.
Very strong. So when you buy REITs, you must buy sponsors that have strong backing. But you must buy REITs with strong backing or sponsors. Okay. So looking at this list, right? Mapletree, CapitaLand, Fraser, CDL. CDL refers to City Developments Limited. That means you know the one of the biggest property developers in Singapore, right? Fraser, Star Hill Global over here refers to Takashimaya. Okay. So Keppel is also very big, right? Then Suntec REIT is Ascendas also very big. Okay. Yeah. So these names that we have quoted, they are strong sponsors. Okay. When you buy into their REITs, you can safely say that you are quite relatively safe already. Okay. As compared to, for example, Eagle, H Trust, the Dasin, Lipo. Okay, Lipo is quite big in Indonesia, but it's just not it's just not performing lah. Okay, Cecil REIT, United Hampshire REIT, all these things, Cromwell, they are probably reputable overseas, but in terms of the listings in Singapore, they might not be as good lah. Why? Okay, why? Okay, so for REITs, the main purpose for us as investors is the high dividend yield lah, right? But I ask you, okay, the highest is what? 14.29. Do you think you want to buy? Because the REIT stated over here might not be sustainable. Why? Why? See, PB is low, right? PB is low. Gearing is relatively red. But what happened to the occupancy?
Very bad, yeah.
It's bad. It's really bad. 63%, you know. That means out of your 10 shops, 6 are operating, only 4 closed down. Right? So do you think this type of occupancy can sustain or support your dividend yield? Hardly possible.
No, yeah.
Yeah, hardly possible. Right? So the next one would be
First REITs. First REIT also always
first REIT,
very high.
Yeah. Yeah. Okay. So looking at this, right? I think it's okay because the dividend yield is 8.9. Gearing is slightly of a concern, but it has 100% occupancy rate. So you can safely say that your 8.9% dividend yield is quite safe, right? And for first REIT, they are in the healthcare industry, which is relatively defensive. Okay, so it's relatively defensive, and therefore what we can do is to further look at their reports in order to know whether it is safe for you to enter, for sure.
I think for
Okay.
REITs, one more important thing also, if I can share, is also the location of the properties, because of course you got different sectors here. So different sector, like for example retail, right? You know which retail mall in Singapore is doing better than the other based on just footfall, etc. I think for REITs, right? First
Yes.
REITs, I think they also got a lot in Indonesia. Then Indonesia, the way they pay rent to REITs maybe is a bit different. Like Parkway, they have quite a few in Japan, but Japan because of what you call currency defluctuation, as well as they're not supposed to earn so much money from for all these care in Japan lah. So that's why that also affects their earnings lah.
Yeah.
So this is also something to take note lah. Property location.
Yeah, that's why it's important to first look at their business. So that's why in terms of the REITs, they are categorized into, as what you can see over here in the various sectors, healthcare, hospitality, retail, etc. Right? In fact, the more defensive ones would be healthcare and industrial. Okay, the rest are quite cyclical, right? So yeah, so in this case, it's really something that you all need to take a look at in terms of the key indicators of financial ratios that I've mentioned just now, like a price to book. You must look at price to book, because the cheaper it is, the better to go in. But you cannot just look at it in silo. You must look into the dividend yield, the gearing, and then the occupancy rate, whether is it a strong sponsor or not. Because you must know that they must be a price setter, right? So even though, like what I mentioned just now, like CDL Hospitality Trust, right? Even though they are a very reputable group, but during market downturn or this thing, do you think they are the price setter? They are not, right? So, but industrial, why are they a price setter? Because the world needs to conduct businesses, even though it's downturn or upturn, right? So the storage, the logistics, all these things still will happen. And under industrial, there's also this component of data center. Data center, unless the company really shut their operations and stuff, right, they will still need to tap onto the services one. So it's quite defensive in terms of the industrial and data center. The only problem with industrial and data center sector is that if their anchor tenant moves out, it will greatly impact on their distribution per unit. Okay, like for example, the anchor tenant of say sorry, not NTUC. The anchor tenant of Plaza Singapura is probably Cold Storage, because they will always be there, right? And they're taking a very huge floor area, right? So you imagine if a Cold Storage exits, then it will impact the revenue or income of Plaza Singapura. Right. So similarly for data center, if let's say AWS is not tapping onto this particular data center already, wow, I tell you, the data center REIT operator will then really need to find another similar anchor tenant, which is quite difficult.
Correct.
Okay. Yeah. So just to summarize for REITs, to me it's relatively easy to understand. You just need to look at the PB ratio. Okay, look at the dividend, look at the gearing, look at your sponsor, and of course the occupancy and the market sectors. So these are just some of the considerations that you will need to look at for REITs.
I think one more last thing I just share also. So for every time these companies they do have this thing called AGM. So people who there are like people who will go and attend it. Like for example, the fifth person is this website. They will go and attend. They will go and throw questions down, and then they will summarize directions forward from the company. So you roughly know like, how come this quarter they're losing money? Maybe it could be a one-off thing. Then they also question why their salary so high, that kind of thing. So it's good to also read this from that kind of a blogging website. It's quite accurate. The fifth person, so you can consider that as well.
Yeah, they have a YouTube channel also. So it's quite interesting. The content that they produce. Yep. Okay, I'll move on. So in summary, I just want to share these 6 points. So firstly, be aware of the market sectors and cycles, but don't follow completely. Okay, stock markets are typically 6 months ahead of economic cycles. And when selecting stocks, always perform peer comparison or benchmarking. Because if you want to compare DBS against something that is unrelated like Singtel, you look at the ratio, it just doesn't make sense, right? So always, if you want to decide to enter into this particular stock or shares, please do a peer comparison or industry benchmarking. Okay, that would be the best way to do it. Okay, stock screeners are good, but you still need to rely on your common or business sense, right? Just like what I shared just now, the dividend yield is high, but whether it is sustainable or not, or whether the company is in good shape or not, you really need to look at the other financial ratios. Okay, and the fifth point is the past records or the track records are not predictive of future performance. This is very, very true. It holds true to every company. Okay, just remember that like for example, I always say SPH, Singapore Press Holdings, right? It has always been performing, but until the digital age, comes in, it just it just didn't make it, right? So past records are not predictive for future performance. And last but not least, it is important to develop your own investment thesis in order to guide your selection, because different people will like different sectors or industry or companies. So you must know what do you want to invest, and then how you want to develop your own thesis in order to guide you. Like for example, recently I entered into the China market because of their they call it the bazooka stimulus, right? So how am I guided in terms of selecting which stocks to buy, right? So you need to develop your own investment thesis through reading or understanding, what are the different sectors that you're interested in. And then based on your approach that you need to develop yourself as well. Like what I said, you can use stock screener, but then it might not give you the full picture. Then you must understand why is this particular financial ratio or ratios making up in terms of the entire situation of the company that you want to invest in. Then it will help you guide your decision making with that. Okay, so that's the end of my presentation. Are there any questions from the audience?